Everyone, thanks for joining. Let's look at financial accounting part 1.1, accounting foundations. Okay, the first question up here: which of the following is not an example of an external user of a business's financial information? A, an individual considering buying shares in the company. B, a bank evaluating whether to loan money to the business. C, a government agency ensuring the business follows tax rules. D, a production manager assessing the efficiency of manufacturing processes. So, mind you, it says is not an example of an external user. In other words, which are the external users here and which is an internal user? You may want to pause and think. Let's look at next. You may have guessed the correct answer is D, the production manager assessing the efficiency of manufacturing processes. As it mentions here, external users are those folks outside the organization who use its financial information. Examples include investors, people who want to perhaps buy shares or invest their funds in the business, creditors such as banks or loan companies, taxation authorities, that can be government agencies. All right. As you may know, the production manager works within the organization or the company. They are involved in the internal day-to-day decision making and operations, making them an internal user of the financial information. All right, let's look at next. Okay, what's one big difference between management accounting and financial accounting? A, management accounting mostly looks at past results. B, outside people like investors use financial accounting most often. C, management accounting does not have to follow strict accounting rules like GAAP. D, financial accounting creates official reports like the balance sheet and income statement. You may want to pause for a moment and think through. It may help to think that management accounting is used by the internal users of the company, and so a company has certain flexibility to generate reports based on their internal needs and may not have to follow set regulated accounting standards. This may give you a hint. Let's look at the answer next. Alright, the correct answer is C. Management accounting does not have to follow strict accounting rules such as GAAP. As it explains here, financial accounting follows strict rules because it's for outside users. For instance, investors or banks who need clear comparable reports. Management accounting is typically for the internal use by company officers, managers, and so forth. So there's flexibility and does not need to follow the same rules. Let's look at the next, third one. Let's consider there's a private manufacturing company in Canada that's trying to decide which accounting standards to follow. They want a less complex and less expensive option for their financial statements, but they also have a long-term goal of potentially going public and expanding internationally. Given this, which accounting standard should be the most strategic choice for them if they pursue or if they prioritize future growth and comparability, even if it means more initial complexity? Option A, ASPE, which is the accounting standards for private enterprises. Option B, IFRS. The International Financial Reporting Standards. Option C, Canadian Public Sector Accounting Standards. You may want to think for a moment. And now let's look at the answer next. Alright, the correct answer here, it says B, IFRS, that is the International Financial Reporting Standards. As it explains here, while the ASPE is less complex and cheaper for private companies, the IFRS, which is the International Financial Reporting Standards, it allows for international comparability and is required if a company goes public, aligning with their long-term growth and expansion goals. All right. Thanks very much for listening. All the best with your upcoming learning.